Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs report and how that's affecting the 10-year yield and mortgage rates. Logan, welcome back to the podcast.
Happy 4th, everyone. I hope everyone enjoyed their 4th of July. It is Friday. Oh my. There should be a rule. No jobs report on Friday morning after July the 4th. That was brutal, man. I'm like sitting there and like prepping. I'm like, oh man, it feels like a Monday, so.
Okay, tell us. Jobs report came in. What did you think?
Okay, this is going to be a little bit nerdy on today's podcast, but last month when we talked about the jobs report, we said specifically that as we get closer to 159 million total employment, the jobs growth data should fall toward my 140,000 to 165,000 range. I would be shocked if we still have big prints above 159 million. But because that's the case, we should all anticipate the unemployment rate getting higher. So in this report, the unemployment rate went up to 4.1%, even though we have 206,000 jobs created. So we've had jobs created every single month while the unemployment rate has been rising. Naturally, the job growth should slow down to the level. 3-month average, if I include government workers, we're running at like 177,000. If I take government workers out of the equation, we're about 146. So we're kind of where we should be. And the unemployment rates is going to rise if we have prints like this. So now we go into this discussion. Has the Fed won its war against labor? Right? The last one of the podcasts we did recently about why haven't rates fall? Even today, the 10-year yield is around 4.30. I'm talking early Friday pricing. Going out in the future, we're going to have to see if the Fed believes that this is a structural, natural increase in the unemployment rate, where they think that, hey, listen, 4.5%, 5% is really low. We're good. Or are they going to start to sound more dovish, worrying that this is not just the standard increase in the unemployment rate without jobs being lost? This is the start of something. This is why I always say you want to focus on jobless claims data. When jobless claims break, everything breaks. So here you have a good example of the unemployment rate's 4.1%, but no job losses. Expect this to be the case going out in the future, that the unemployment rate can increase while jobs are being created. But if you start to lose construction workers, if you start to lose manufacturing workers, if we start to get these kind of cyclical sectors that we get a heads up before every recession, then it becomes the Fed is now actively pursuing a job loss recession, which I've always said the Fed's going to talk really tight until the labor market breaks, and then they're going to, cry uncle and start being accommodative. We're getting to the stage where we could start talking about this because the unemployment rate is increasing and the job openings are going lower. Wage growth is under 4%. We're heading toward that 3% level. So it becomes more important for housing, because what does housing need? Housing needs the 10-year yield to go down and mortgage rates to go down to grow sales.
So I think your level always for jobless claims is 323,000 on the 4-week moving average, right? And where are we right now?
We are slowly moving above the low-level trend, and I think what everyone else is seeing on the jobless claims data is there's a continuing claims part of jobless claims, and that's heading toward 2 million. That is people filing for unemployment benefits that are after 10 days. So that is starting to look like it's deteriorating earlier. I would argue there's a very seasonal factor into that, but jobless claims right now, to me, we're slowly moving up on the 4-week moving average. The headline prints are still under 250,000. So it's not like we're anywhere close to getting there yet. But the trend, you put jobless claims, job openings, wage growth, jobs data slowing down, you put them all together, you got that what I call the enchilada of the labor market getting softer. But I still think that the Fed is really pressed on trying to get wage growth down toward 3%. So we'll see. It's the attack on labor is finally getting to their metrics. We talked about this many months ago, that they're very big job openings people. They're very big unemployment and jobless claims people. I mean, Jerome Powell said it at one of the Fed meetings. He's like, oh yeah, we watched jobless claims and they've been falling for the last few months. Well, they're not been falling in the last few months anymore, right? Job openings, job openings are, the quits ratio is pre-COVID. There's these data lines that they should be able to comfortably move to the next stage of this. But I think the unemployment rate is going to be a tricky one for people, because we can have like job gains and have the unemployment rate keep on ticking higher. This is on the Fed's, the ball's on the Fed's court now on how they want to handle this. Of course, not a pivot person until they actually, see the labor market break. But jobless claims, the headline prints are under 250,000 still. The 4-week moving average is heading up there. We're still far away from 323,000, but this should give the Fed a little bit more cover to actually want to cut maybe once or twice for the rest of the year, especially if the labor market starts to get worse and worse. And the jobless claims will force that issue on them and the bond market more than anything else.
So this is where it's so helpful to have somebody like you who looks at the whole picture, because, so when you talked about construction jobs, right? You watch the new home sales, you watch existing home sales, all of that. So when you look at the construction jobs for both multifamily and single family, what do you see and what do you think that trajectory looks like?
So here's the thing: construction jobs actually grew in this report, but we have to separate construction jobs and residential construction jobs. Like here's a good example: data center construction is booming, right? That's the one sector where a lot of construction workers are working. They're not necessarily residential workers. Single family construction workers are actually not at the peak. They have actually fallen already. They're upticking just a little bit, but we're not at highs. Apartment construction is still growing because we still have a backlog in there. But single family permits and for single family and 5 units are falling. 5 units are already at a recession level. So once these jobs get done, there's no work really. And, residential construction workers don't just, okay, let's all go into the data mining construction sector. So we're mindful of this, right? We did that podcast a few weeks ago that construction labor is at risk now because both single family permits and multifamily permits are falling together. That hasn't happened post COVID, right? When we had new home sales falling, single family permits fell, but multifamily permits were rising. Now they're both falling together. So there are clues, right? Mother Economics, serial killer. She wants to get caught. She's leaving crumbs, right? She's leaving crumbs for everyone. It really does become more interesting on how the Fed wants to handle this. They can solve anything they want, right? This is by choice, right? For 2 years we've talked about this. This is a public policy choice to attack the labor market. So we're getting to the point to where maybe some of their baseline cover rates, like Jerome Powell said, the labor market is strong, unemployment rates are rising. Labor market is strong, job growth is slowing down. They have to change the verbiage because it looks a little bit silly now. But again, this morning, a lot of people are saying, hey, why isn't the 10-year yield even going lower today? The unemployment rate. So if you want to understand why the unemployment rate is running, is that the run rate is you need big job reports to keep it low, and we're not there. This is why I highlighted for 2 years that once we get to that 159 million total employment level, the job growth, the 3-month average should be 140 to 165,000. Right now, the 3-month average is 177. If I take government workers out, it's 146,000. We're looking where we should be. But I think the Fed wants to keep pushing, and attacking labor more because I don't believe they're comfortable with 3.9% wage growth. Americans are making too much money. Bad.
Right.
Neil Kashkari is still terribly mad this morning.
So let's talk a little bit before we leave the Fed for other topics. Is we're only in July. We've got a long way to go before the election, but it's going to be here before we know it, right? 4 or 5 months. So when you look at that, what is that the variable like? If we have an administration change, what does that do to the Fed and their policies? And do you feel like they're going to, in between here and there, try to be like, let's make sure we get done what we need to get done? What does that look like? What's that impact?
The timing of the labor market getting softer as we get closer to the election, I think that's just the economic cycle itself. I don't think the Fed really cares too much about the presidential election in terms of where they are right now. If they came out and said, okay, well, listen, the labor market's getting softer, we need to cut rates, I don't think anybody would fight them on this. I think the group of people that wants the Fed to keep on hiking rates are the people that have been calling for a recession for many years, and it hasn't happened. So they just want the Fed to make the mistake and keep policy restrictive too long. So economic cycle over politics on this one, because the dynamics are the growth rate of inflation has fallen on a very big fashion from the 12-month average, but the labor market is starting to show the cracks that the Fed wants. So how do they tactically handle that with, I think, 4 Fed meetings left? The verbiage, right? So whenever these presidents talk, they talk a lot, right? Every week they're at some speech. Look at their verbiage, see if they're talking more about the dual mandate, right? And the dual mandate is what they kind of are traditionally about. If they're a single mandate Fed, then they're just going to, what they did in 20, to keep hiking until you get restrictive policy. Now it becomes a little bit different. So I know a lot of people want to focus on the politics of this, but I always think the economic cycle matters more. And it gets maybe a little bit more challenging for the Fed on verbiage. But if jobless claims start to rise, none of that matters. The 10-year yield starts to break lower on them. The front line of what the Fed wants the market to do will do it for them. We'll see if that occurs, because there's a chance where jobless claims might be rising literally right when the election will start. So it's going to be, the timing of everything is going to be really crafty at this point, because we start to see the deterioration. But it looks to me still we're kind of where we should be. But the next stage isn't, right? The next stage is actually the labor market breaking. And I just think the Fed feels more comfortable cutting rates and talking with the labor market in that kind of mode than they have been in the last 2 years.
I mean, normally you'd say, okay, well, Biden came in, he didn't change Trump's, pick for reserve chairman. Trump's the one who replaced Yellen with Powell. And so you're like, okay, well, we should be good either way. Biden hasn't made that change. And then if it's Trump, well, it's his guy, but Trump's kind of unpredictable. He likes to fire people just for no reason. So
I know the president was talking about maybe trying to get some rules where they have a little bit more power over the Fed. When I think about Trump, I think the Trump wants the dollar to go down, and probably want rates to go down. And this is we talked about this this week even. I don't think Trump is going to go into a full trade war tariff in this economic backdrop, right? He talked about, he talked very tough on trade wars. He didn't do anything on the trade war until the corporate tax cuts were in. He knows the game. Right. The last thing he wants is all of a sudden tariffs going, stocks going down. Stocks are near all-time highs. He doesn't want to play that game. So I know we all want to put the president into this omnipotent, all-powerful position of economics. Literally, it's the last thing on my mind for economic cycles. I mean, economics in general is demographics and productivity. The rest is kind of storytelling. But here, the economic cycle, we're kind of toward the end of the Fed being very restrictive, and that matters more about who the next president is. But again, if Trump wins, then we'll discuss some of the policies that could affect rates. I know a lot of people saying, well, Trump's tariff plan is inflationary. There are already people saying it would add 5 more rate hikes. Let's cross that bridge later on. But for now, focus paper, rock, scissors, labor over inflation, right? So we want to focus so much on the labor market because that to me matters more for the real estate and mortgage industry than anything else.
We've talked a little bit about rates and where you think they're going to go. Anything more on that, or you feel like we've covered that?
Yeah, on the 10-year yield, that kind of that 420 level is again a tough nut to crack. We've taken back a lot of that increase that we saw recently. When we had softer inflation data and the 10-year yield went up, so things are a little bit more calm. But keep an eye on that 420 level, and keep an eye on really what Fed presidents start to say. There's a series. Whenever we have jobs week, there's a forward-looking kind of, okay, the Fed has to create these speeches. Now it's a little bit different. And again, job openings, they're at their target. Wage growth, I still think they want to get 3% or 3.9% is too high for them. The labor unemployment rate is up, so they're winning that war. So let's see what Fed presidents start to say going out every single month after every jobs report, because their verbiage should change a little bit.
I like it. Okay, so next topic is inventory, because sadly, I mean, we have seen it now get to some levels that you really wanted to see, getting into that 11 to 17,000 range. Are we going to continue, or you think we've hit it?
I need one more week. If I could just get one more week of that, I'm giving it an A plus. Yeah. Again, for me, my whole thing is that we needed to get inventory off of those levels because again, the housing market right now is dealing with elevated rates. We saw what 6% mortgage rates did to the existing home sales market. So we're creating a buffer. This is why I love 2024 more than 2023, because we're creating a buffer, because you can't assume that rates are going to be 7 to 8% for the next 200 years, right? The economy would have to stay non-recessionary. So now that we have a buffer, if rates fall, there's more choices and there's less too many people chasing too few homes. Right. That was always my concern. Once we broke down to certain levels, I was just like, okay, this is the hungry hippo game. There's too many people chasing too few homes. That could create price inflation to get out of hand. We kind of saw what happened in late 2022 to 2023. I mean, even mortgage rates getting down to 6%, it created the longest time to get the seasonal bottom. Inventory really didn't grow. And it wasn't like home sales were booming either. It was near 4 million. It was very low levels of sales. So I'm just very happy that we've created this buffer. If I could just get one more week between 11 and so far this year, whenever we've had that target levels, it's stuck between 11 and 17,000. We haven't had anything above 17,000. We've always stayed in that range when we check it off. So if we could just get one more week, I'll be completely happy. Now, new listings data, it's the holiday week, so everything's going to fall. Right, inventory, everything July the 4th weekend, and then we're going to kick it back up again. But new listings data will start its seasonal decline. It'll be the second lowest new listings data ever. But the active inventory, we'll see what happens, because let's assume that the labor market starts to get weaker and weaker, and the 10-year yield starts to break, and rates start to come down, and the spreads get better. We're going to have to keep our eye on that supply and demand equilibrium and see how that works itself out. But it's one of these things to where hopefully I'm trying to get people to understand how the labor market works. But remember, how the Fed looks at the labor market is going to be different than all of us. I know a lot of people, the labor market's breaking everything. The Fed's probably like, no, the unemployment rate's going up. That's what we wanted, right? Jerome Powell said that. The unemployment rate, the labor market should be cooling off. That was our whole intention. So remember, labor is their attack. So we focus on other data lines. The jobless claims data becomes more and more important going out in the future. And that matters a lot to housing, right? It's just the world we live in after qualified mortgage. The 10-year yield and mortgage demand revolves around where the 10-year yield and rates go. And every time the 10-year yield falls noticeably and mortgage rates fall, we do see that pickup in mortgage demand. We get that little boost in sales, and then rates go up. In a labor market is breaking environment, that doesn't happen anymore, right? You don't have rates going up, and when the labor market is breaking, you change the whole dynamic of the housing market when that occurs. This is why I always try to get people to focus on labor data, and then we take it from there. But right now, the crumbs are there. The crumbs are there, and I'm just so happy that inventory is growing, and I don't have to worry about too many people chasing too few homes. Now, I know there's parts of the country that aren't that fortunate. Of course, Texas and Florida are outsized. pushers of the inventory data this year, but we're still in a better place than we were in March of 2022 when we only had 240,000 single family homes available for sale.
Which is crazy in a nation of what do you all say, 330 million people?
A nation of 336 million people with 159 million people working. That's a non-farm payroll. If I take the other workforce, we're over 162 million. So yeah. I mean, just that's why I try to focus people on that. Think about an army of 336 million people with 162 million super soldiers, and you've got 240,000 on your side. That's not good. You're not going to, now, not everyone's a home buyer, of course, and not everyone's looking to buy a home, but just the sheer size of the US compared to what the inventory was available. This is why the whole team higher rates of 2021 was like, I still to this day do not think people understand how low inventory got at the worst time possible. So that explains home prices up 20% in 2022, which is in 2021. That's just not a good thing. On the national data to go, I can understand certain cities can do that, but for the national data to go up 20% in 2021,
It's bad.
Savagely unhealthy.
Yeah, exactly. Savagely unhealthy. Okay, so I am going to drag you back into politics one more time. Just one more talking point that I want to ask you about. I know you hate politics, but this is very germane. So when I was talking to James Kleiman, our managing editor, a couple of days ago, he and I were talking about the fact that if you did have an administration change, you might very well have an FHFA head change, right? And last time that we had a Trump administration, just toward the end of their time, they were like, you know what? We should really get those GSEs out of conservatorship. They just really started too late. They ran out of time. They come in and they have 4 years to do it. What is your feeling about FHFA? I know that you have strong feelings about, like, is it good for Fannie and Freddie to be in conservatorship or not?
If they become publicly traded companies without government backing, there is a risk of lending getting tighter, because I hear all these stories. Oh, all these banks are capitalized, and all of a sudden the market dictates to you. So one of the unsung heroes of COVID was that Freddie and Fannie were already in conservatorship and credit flowed. Credit's flowing, right? So if that goes away, then you do have to put the risk of whenever there is a recession and their stocks go down, and that they're not protected. They're just simply too big to have them on their own, right? They're simply too important. So if that does occur, then I would have to put into the if the stock market is treating their stock prices wrong, and they might not be so credit can get tighter on their side as they don't have enough capital, or the market doesn't believe they have enough capital. I know everybody says if they get $250 billion, they have enough capital. I saw what happened when they were going into conservatorship, and the whole process and this congressional hearings, and it's just time wasted. We don't have to worry about that when they're not publicly traded companies without a government backing. So if that occurs, it's going to take a long time. But I've said this like 10 years ago. I don't expect them to ever leave conservatorship, right? And even through now, it's 2024. But if we have to cross that bridge, we'll cross that bridge once the final signature is done. But in this case, I always think it's a positive that the biggest giants in lending do not have to worry about the markets deteriorating on them first, and then them forcing to do credit restrictions because nobody believes they have enough capital. And we see banks just get, there's like $1 trillion of unrealized losses on the bank's balance sheet. So if you like playing with fire, go ahead. But I always thought that was one of the benefits about COVID-19, is that we just basically had credit flow, because majority of all lending is through government agencies, whether Freddie, Fannie, VA, FHA, whether they buy or insurance loans. That's our strength, right? It's our 30-year fixed mortgages. It's our system. When we allow it to get into publicly traded companies, like in 2008, where you create these exotical and debt structures and capital markets breaks and then credit crashes, right? Not a positive in a time where you need it. So cross that bridge when we get there, Sarah. That should be a
Okay.
lovely conversation whenever that happens.
Okay. Well, thanks for giving us your insight, and thanks for joining us on this Friday after July 4th. We will talk to you again soon.
Pleasure as always, Sarah. And I just want to add that, we've talked about cakes and ice creams and everything, but one of our fans, because we're talking about chocolate mint ice cream, was literally listening to our podcast. She stopped her car, went and got mint ice cream, sent me a picture of it, and said she's going to blame me for this chocolate eating. But I was thinking about, remember in New York when we were leaving the NBA
Oh
event,
my
and I
gosh.
had that giant ice cream, and we went into the elevator. Remember that? Remember that episode?
Oh yeah. No, this this is see, I can't take you anywhere. Things happen with you that don't happen with other people, and I just get to be a spectator and just laugh. And this was
So we
one of those times.
we go into this elevator, and I have a big chocolate ice cream in a cone and everything, and you walk in, and how you walk into the elevator and you see these two ladies, and they're like, like, oh God, they're going to give me trouble.
They were
So I
very
was like,
well
not,
dressed. They were very they and it was a very small elevator. That's the other thing. It's a New York
yeah.
elevator. It was
So
very small.
I just thought I'm just going to throw it back at them. They're looking and kind of slightly licking their lips. I said, oh, do you want to taste?
Oh
And
my
then
god.
that kind of put them back. And then you get off on the next
So
floor.
yes, so the doors open and I walk out and I was like, I am leaving that mess behind. And the the sound I hear in the elevator of those two ladies reacting, I was like, will I ever see Logan again? I'm not sure. I don't know what happened to him back there. I was just like, but you know what? It's your own fault because you said it. So
Hey,
I don't
we
know.
are going to sponsor ice cream. Look at that's what we do. We get ice cream sponsorships because we're helping people work out because they listen to us, and we're pushing chocolate mint ice cream consumption.
Oh my God. Okay. Well, thank you so much, Logan. And we'll talk to you again soon.
Talk to you later.